On behalf of Edelweiss Securities, I welcome you all to the Q4 FY18 results conference call of Simplex Infrastructures. Today, we have with us from the management side, Mr. Amitabh Mundra, promoter of the company, and Mr. N.K. Kakani, Senior Executive Director. I would now hand over the call to the management for their opening remarks. Over to you, sir.
Good afternoon, ladies and gentlemen.
Good afternoon, everybody.
We thank you all for attending our conference call on the Q4 and the annual results. First, I'll talk about the yearly results and then Q4 also. The turnover for the year is 5,766 crore, which is just 3% higher than the same than the last year. EBITDA is 805 crore against 778 crore, 3.5% higher. Depreciation 183 crore against 198 crore. The EBIT is 622 crore against 580 crore, that is 7% higher. The interest cost is 471 crore against 445 crore, which is 6% higher. The PBT is 151 crore against 135 crore, 12% higher. The PAT is 117 crore against 120 crore last year, because last year the tax was only 14 crore because of some prior year's tax refund, and this year tax is 34 crore. The effective tax rate for the current year is 22.5%, and last year it was 10.6%, but in future it is going to be full 34%. The EBITDA margins, including other income, is 14%, 14.1% against 14% last year. The PBT margin is 2.6% against 2.4%. On the balance sheet side, the gross loan is 3,600 crore, but net loan after cash adjustment, cash is 105 crore, so it is 3,500 crore, which is lower than December figure, but higher than March 17 figure. The order book is 18,622 crore against 16,500 crore last year. The composition is 97% domestic, 3% overseas, and 76% government and 24% private. So far as the result for the quarter is concerned, Q4, the turnover is 1,632 crore, which is 6% higher than the same quarter last year. The EBITDA is 208 crore, similar 210 crore last year, and interest cost is 125 crore against 113 crore last year. The PBT is 40 crore against 49 crore, and tax is 29 crore against 67, because last year we had this last quarter tax refund also. And in this year, we have, in this quarter, and for the whole year, we have written off about 81 crore, bad debt written off, and net write-off is 59 crore after adjustment of some Ind AS of 22 crore. So that has affected this quarter's results in EBITDA margin. So EBITDA margin with other income is 12.8%, but if you add that write-off adjustment, it will be close to 14%. So that is in the overall synopsis, and we'll be happy to answer any of your questions. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. The first question is from the line of Nitin Arora from Axis Mutual Fund. Please go ahead.
Hi, sir. Good afternoon.
Good afternoon.
My first question is, when we look at the statement issued by the auditors in your notes, where he's stating that these are certain amounts which, in his view, finds unrecoverable or, demands a write-off, or creates I would not say write-off, but demanded a provision to be created. I just want to understand this nature of this transaction. Was it something we were waiting for an auditors to raise an alarm, and that's why we have taken a write-off, and in that case there would be many such that can come because of the nature of our unbilled amounts? Or is it like this is a kind of a one-off which was not recoverable and that in the board meeting got finally decided to take a write-off? Just need your view on that.
You see, basically, the write-off which is there of 81 crore or 59 crore net of Ind AS adjustment, that is irrespective of the auditors, because that is what is our normal every quarter. We do line-by-line assessment and do write-off. Now, only auditor's point is this Abhijit Infra of 106 crore plus 10 more crore of some advances to supplier. That is what they have qualified and quantified, which requires adjustment to the profit and loss report. Now, Abhijit Infra, we have been all along talking about that it will be written off this year. We have not written off last year actually. That's why it has suffered the qualification and the quantification. And of course, during our discussion, we have always mentioned that this Abhijit Infra, now we find more and more clarity is there that it is unlikely to be recovered, although we have arbitration cases against them. About 350 crore worth of arbitration cases are there. So they also have to be wound up. And we know that even if we win the arbitration cases, there is no chance of recovery. So, in fact, during our various discussions recently, we have given the indication that 106 crore will be written off this year, but we have not written off in last year. So that is where the major qualification is there, which has required recomputation of profit, requiring recomputation of profit as the auditor's qualification. Rest of the other things they are mentioning that they are unable to comment because of inadequate records. Now, that is the case where, you see, 860 crore out of unbilled revenue, unbilled sales of 4,000 crore, they have mentioned. Other things, for balance 3,200 crore, they are satisfied. Now, 800 crore kind of thing is like this, that one auditor who is continuing auditor, is satisfied with those, whatever records they have seen. Now, this is a new auditor. As you have seen, PwC was our auditor since 1924 for 93 years. And they continued till it was required to be rotated under rotational policy. So from second quarter, the new auditor has come in. They are also among top 4. And PwC was also among top 4. Now, they are new. Their Kolkata office is also new to this kind of industry, and our 220 kinds of projects spread across the country. So there has been a positive time that they could see whatever records are available at the site. Basically, they want confirmation from the client, which could have come to head office. But in case of unbilled sales, the confirmation is not that easy to come. These are only minutes or the email exchanges or the local discussions which are minuted down. These and discussions are verbal level. But if the previous auditor had the full understanding and they had the full bearing because they have been visiting at least 10 to 12 sites every year. And these auditors are yet to visit, they have to, I think in next 2 to 3 quarters, when they visit these sites or part of these sites, they will get satisfied and these comments should get diluted. That's what we believe, because there will be records available at local office and they can have discussions with some of the clients, but there may not be written confirmation from them, but verbal discussions can take place. Sir, I hope I have answered your question.
Given the unbilled part which you said about 800 crore, they are not satisfied, and on 3,200 crore, they are more or less satisfied. What I understand, auditors generally don't give these things in writing. So what you're saying is your verbal communication, right? That's what got discussed with you in the board meeting.
No, verbal communication with the client. That's what I meant to say.
Okay.
And auditors side. Yeah.
So when they said about records, which they have given in your which they have given in the minutes, what records are they talking about? Is it the records from a
They want
company like...
confirmation from the client, you see, basically. Records are that we have given emails to clients, and which is not contested by the client. That is our record in these 800 kind of cases.
Is the amount value mentioned in that record?
Yeah, yeah.
For example, a client like Reliance or a sale.
No, you see, Reliance or sale is not figuring here, but what I'm saying is that amounts are mentioned because these are the transaction entries which are passed in the books of accounts. So there is a basis for that.
And how do you see that? Do you see a risk of further book? Because if we remove even from the unbilled part, which we have been struggling for long, even in the current receivable, which is still almost like 3,200 crores of the top line company of 5,700 crores, which remains as it is. So do you see a chance of further provisions from this book as well?
You see, I think that Abhijit Infra, of course, will be written off. That is one part. And if we look at last 10 years average write-off, 0.4% of the revenue will get written off, in the sense that it will be on line-to-line basis assessment and write-off. But that is what we feel, that 0.4% or 0.45% kind of thing will be the impact every year.
So that I agree. I mean, generally an infra company creates a provision, but we are making a recurring write-offs on a 0.4 basis. That's what I was trying to understand. Nothing else. All right. Thank you very much, sir. All right.
Thank you. The next question is from the line of Ujjwal Shah from Quest Investments. Please go ahead.
Yeah, thank you, sir. Just wanted to understand how much write-off will we take for Abhijit, because in the notes that they mentioned, they also have included other trade receivables of around 50 crores. They have included advance to suppliers. So the total amounts to around 140 odd crores.
Right.
Whereas our understanding was Abhijit Infra write-off would be around 100 to 105 crores.
Yeah. So Abhijit Infra write-off will be 106 crore, and other things I think we will produce the document and that will be satisfied.
Okay, sir.
Yeah.
Secondly, sir, wanted to know, usually 4Q we see a good bump up in terms of revenues and in terms of execution, but this 4Q we didn't see that. So any particular project which was lagging behind and we might see spurt up demand in the coming quarters, as well as thirdly, that you have, now that you have raised money and we have adequate funding with us, what kind of revenues and margins are we targeting for next 2 years?
You see, basically, the fourth quarter was also impacted because of the some of the projects getting delayed and also because of working capital constraint. But this year, we are targeting revenue growth of 40%. That is, our target is to achieve 8,100 crore kind of sales. And so far as execution capability is concerned, there is no question. The order book is available and the bid pipeline is very strong. Order book is 18,600 crore and the bid standard are about 22,000 crore, and the bids to be tendered for which we are pre-qualified are in the range of 35 to 40,000 crore, which may bid or we may not bid because they are very selective in bidding. So business is available and execution capacity is available, and now the working capital is also available, and coupled with our recovery targets on the old debtors and our effort, I think we'll be able to achieve 8,100 crore sales this year, because internally, if you look at from bottom-up approach budgeting which we do every year, and 3 years rolling plan we make, so our internal target which came up was about 9,400 crore for each job. The project manager and the coordinators have given the target, but we after discussions we toned it down. And one of the reasons for prolonged board meeting was this operating plan, because in the board meeting also we get the operating plan approved, and that is where the board members who have seen that last 5-6 years of stagnation they have seen, so they were inquisitive about how the 40% growth will be achieved. So operating people also made the presentation for major jobs, and that took a lot of time of the board also. And it was agreed that yes, 8,100 crore will be achieved this year. And the EBITDA margin is 13.5% blended EBITDA margin in the order book, because we follow a cost to complete method. So each project we know what is going to be the margin to complete it. Also providing for the standard delays and other things. So 13.5% plus some other income, etc. It should be about 14% kind of margin. And but in our projections we have considered 13.5% EBITDA margin.
Okay, sir. And sir, in terms of debt recovery targets for next 2 years, so how are we looking at that?
Target, you see now, out of these unbilled and the billed revenue, 800 crore is a target for this year, and 1,000 crore is the target for next year. And in these 2 years, around 200 crore will get written off also, 106 crore of Abhijit, and about 0.4%. That's what we have budgeted in our projection, 0.4% of enhanced revenue. Enhanced revenue target this year is 8,100 crore, and next year is 11,000 crore. So on that, 0.4% also. So that takes away 200 crore. So 2,000 crore will get accounted for. Balance about 500 crore still remains some old dues as of now. So that will be seen or recovered in third year, or will suffer some further part provisioning, but most of that should be recovered.
Okay, sir. And in terms of the gross debt targets, where do we see our gross debt going ahead? And are the talks on with the bankers now that we have brought in so much of cash? We were thinking of a rating upgrade. So where are we in that sense?
Actually, we have yet to begin submit papers and new projections with the rating agency. That will take time. It will take about 1 month time.
Okay, sir.
We have to assess it. And bankers, we have had no problem so far. We will have no problem in future, because we have guarantee limit sanction of 8,000 crore, utilizing 5,500 crore. So we have enough headroom. Plus we have funded limit 2,600 crore, which will be now reduced less. As you said, the target debt, now this time debt is 3,600 crore gross and 3,500 crore net. And gross debt for FY19, our target is 2,800 crore, or increase sales of 8,100 crore.
Okay, sir.
Yeah.
Thank you. I'll jump back in the queue.
Yeah.
Okay.
Thank you. The next question is from the line of Shravan Shah from Dolat Capital. Please go ahead. Also, before we take the next question, a reminder to the participants: to ask a question, please press star, then 1. We take the question from the line of Shravan Shah from Dolat Capital. Please go ahead.
Yeah, thank you. Sir, trying to understand, actually, when we started the first quarter concall of FY18, we targeted 15% revenue growth, then we slowed down to 10%, then 5% for FY18, but even that also we did not meet. And now, post the equity infusion, we are saying we will be having a 8,100 crore top line and 11,000 crore. So just trying to understand how confident we are and from where it will be. And then if that is the case, then with that kind of a top line also, how do you see the working capital and particularly the debtors? So still you are saying 2,800 crore debt, significant reduction, close to 800 crore. So still not able to understand how this will work out. And also at the same time, have you seen in the last 2 months, this April and May, the same kind of a revenue run rate?
Yeah, actually, this industry we have seen several cycles. The down cycle is normally 3 years. This time the down cycle has been 5 to 6 years. So in last 5-6 years we have stagnated. But despite this 5-6 years of stagnation, if you look at our growth in last 10 years, despite 6 years of stagnation, the growth is 7% CAGR. 15 years growth is 17% CAGR. So it means the growth, excluding the 6 years, would have been 25% in the previous period. And in fact, we have grown in few years 65% year on year, then some year 35, some year 25, that kind of growth we have seen in the good cycle. Now we believe the good cycle is around the corner, competition intensity is low, and order booking is really good. Bid pipeline is very strong. The opportunities are great. Margins have improved. And so also now the focus of the government or the other client is on project execution. And we have seen whenever the focus is more on project execution, faster delivery of the project, the payment comes faster. And in fact, we have analyzed our new orders will have a net working capital cycle of 90 days. And in our projection, we have considered 90 days net working capital cycle. So with the result, the current working capital cycle of 227 days in our projection will come down to 190 or 194 days in FY19. So that will lead to reduced borrowing despite higher turnover. And 188 days is FY19 and 157 days is FY20. And since it is a 3 years rolling plan for us, so 136 days in FY21. So that's a great, as the 90 days working capital cycle order inflow percentage increases in the overall, so and the past recovery takes place. So this is the kind of improvement we see. And in fact, we remember in FY9-10 we had overall working capital cycle of 90 days. Overall, what we are talking about now, 188 days in FY19, that was just 90 days in FY9. So we are only projecting a modest and gradual decrease. It's not a very big decrease in the working capital cycle, which is achievable. And that's how the debt reduction will take place despite the growth. And EBITDA margin we are keeping at 13.5%, although that may also increase because the ticket, you see, EBITDA margin is improving on two accounts. One is the competition intensity being low. Second is that average ticket size of the job is rising. Our 220 projects we have been having for last 5-6 years. 6 years back, our average ticket size was 55 crore. Today it is 250 crore. And going forward, it is 350 crore if you look at big pipeline. And further it will rise more. We have about 5 projects which are more than 1,000 crore. And about 10 projects, 11 projects about more than 700 crore. So I think average ticket size is also rising. That brings about some operating efficiency and improves the margin.
Sir, I didn't get that in terms of the working capital days. You were saying for FY19 it would be 194 days or 188 days?
188 days.
188 days. And out of that, debtor days would be how much now for FY19?
FY19 days I have to compute separately, but I can give you the debtor's number. Debtor's number for FY19 will be 5,800 crore. So on 8,100 crore turnover.
So even FY18 numbers is close to 5,984, 6,000 crore. Yeah. So despite there is a sizable, not a sizable, I would say sharp rise in the top line, then also we are expecting a significant recovery. So any special steps have you taken that you are seeing or already have witnessed in 2 months that data is recovering because it is difficult to digest what you are saying?
You see, if you look at just this Q4 also, in Q4 our net working capital from December, you see December figure we already discussed. In Q4 our reduction in net debt is by about 22 crore and increase in net working capital is by 31 crore only. That's because although the debtors have risen, but so also have mobilized advance because of the new order. So similarly, in the next year, when the order intake is higher, the advance also rises, although the debtor is 5,800 crore, but the net working capital is 188 days.
Okay. And in these 2 months, have you seen the same 40% kind of growth in the top line?
No, we are not seeing, but the growth is about 10 to 12%, which is normal for this first quarter.
Okay. And sir, this EBITDA margin 13.5%, it is including the other income you are saying, or without?
For projections, it is including other income.
So without other income, it would be how much? 12%?
About 12.5.
12.5.
Yeah.
Okay. And the Capex would be for FY19 would be?
200 crore.
200 crore. And inflow we are targeting another 7,000-8,000 crore?
No, we are targeting 9 to 10,000 crore.
Okay, 9 to 10,000.
For next year's growth, we need that much.
Okay. And the tax rate would for FY19 would be?
34%, full tax.
Full tax rate. Okay. That's it from my side, and all the best.
Yeah, thank you.
Thank you. The next question is from the line of Ashish Shah from IDFC Securities. Please go ahead.
Yeah, good evening, sir. Sir, I must have missed like the first 10 minutes of your call. I just want to check from you, what is the specific reason for the auditor to comment that, about 860 odd crores of unbilled revenues is what they have not been able to audit or unable to comment. So, from where does this 860 crore number come, sir?
You see, 860 crore number comes from some of the accounts where, you see, basically, and these are unbilled sales because these are not confirmed by the party. They are looking at written confirmation from the party, whereas our evidences are by the mails written by us to them or the minutes of the meetings at the local level. And since they started audit only from the second quarter, so they have had positive time to examine or to visit sites and to examine all the records. And we believe that in next 2 to 3 quarters, they will be able to visit some of the sites and examine the records also in more detail and would be able to satisfy themselves. Because our previous auditor, PwC, they were aware of this construction industry's nitty-gritty, and they were visiting sites every year, about 10 to 12 sites. So they had the full hang of how the system works. That on verbal discussions, some things work, something works on understanding and emails, and then it gets sorted out later on. And I think in 2 to 3 quarters when because their Calcutta office hasn't had much of the experience with construction industry, and when they visit the site and discuss with some of the clients and our local people, they will be able to tone down these numbers.
But so this 860 is what they are saying the clients have not accepted in principle. And this is
they don't have confirmation from the client.
Okay. So if they are able to receive the confirmation, probably this number goes down.
Yeah. One thing, receiving confirmation. Other thing is even discussion with the client, the verbal confirmation, yes, the work is done. There are photographs of the work, but then there has to be confirmation of the amount payable by the client. So, and plus our email exchanges and then these minutes, the local level minutes, because these projects go on for 2 to 2.5 years time. So these records are at the sites. So,
typically which clients are these, sir? Is this government clients or private clients?
Yeah, these are mostly government clients.
Okay, these are mostly government clients.
Yeah.
And in any specific area or generally spread across?
Generally spread across. These are multiple clients of small amounts of these clients.
Okay. Also, sir, we have been, saying that 800 crores is what we'll target to recover in 19.
Yeah.
So, can you just probably highlight a few top accounts, maybe 4 or 5 accounts comprising maybe 50-60% of the total?
Yeah, I will say. I will tell you. You see, one is our own this BOT project, where the outstanding is 238 crore and 150 crore of arbitration award is received, and earlier the guarantee were placed with the High Court. Now there is a change that we have to give the guarantee to NHI, and the guarantees are coming back, and we'll give that in 10-15 days. And I think within 1 month's time from now, we should get about 75% of 150 crore, that is 112 crore in our SPV, out of which about 70 crore we will receive in 1 to 1.5 months' time. So that is one thing. And then from Reliance Jamnagar, we have already received in April and May about 27 crore from 157 crore outstanding. And out of 130, we'll receive another 50 crore on handing over of some of the parts of the work. And balance amount also will receive 23 crore retention that will receive next year. Balance amount will receive by March. Similarly, from this Bangladesh project, which is Bangladesh project, we have just a second. We have 105 crore outstanding. We have already received 20 crore in India. So now it is 105 crore. Earlier it was 130 crore. And out of this 105 crore, 75 crore is received in the escrow account in Bangladesh. And that is pending assessment of this year. Previous 25 crore was received when the assessment was completed for FY16. Now FY17 assessment is yet to be completed. And that 75 crore we should receive this year, and balance 30 crore also we should receive this year. Similarly, this Mohali will receive payment of 25 crore this year and 35 crore next year, because from Mohali we will receive total 60 crore. And MMRDA will receive about 32 crore this year and 20 crore next year. Indore Municipal Corporation, 15 crore this year, 34 crore next year. So these are the major accounts, and total of the accounts 800 crore this year and 1,000 crore next year. These are accounts like Bilaspur, then there is a sale, there is GSFC, there is one Dubai party, then Mumbai, MMRDA, then Jabalpur, then PWD, then military, DGMAP, Director General of Military Accommodation, and then this is...
Sir, sorry, in terms of the own BOT, you explained broadly what is the status, but for the others, especially the Jamnagar, receivables as well as Mohali, is there any sort of an arbitration which is going on?
No. On Jamnagar and Mohali, there is no arbitration. These are normal costs. These are not arbitration, dependent on arbitration.
Right. Sure. Thank you very much.
Thank you. The next question is from the line of Rishikesh Bhagat from LIC Mutual Fund. Please go ahead.
Good evening, sir.
Good evening.
Just wanted to know, this auditor qualification, will it anyway impact our debt rating, or does it have any implication on bank guarantee or anything?
It will not have. The reason is that the only qualification which impacts the profit and loss account, 106 crore is already explained to all these rating agencies and bankers that this will be written off. And balance about 35 crore is not a very material amount. And in any case, we have the documents to prove that it will be, next time it will be rolled back. So it will not have any impact on our rating or banks.
Okay. Thank you.
Thank you. The next question is from the line of Divyata Dalal from Systematics. Please go ahead.
Yeah, good afternoon, sir. So my question pertains to the arbitration amount. If there is some movement in that amount, if you can just help us out. At the end of December, it was 2257 crores outstanding.
Yeah, 2257 crore arbitration. Yeah. Yeah, basically, the arbitration, out of that included 455 crore of Abhijit arbitration, so that we have to deduct from there. So,
455?
Yeah. So, overall arbitration amount as of now is 1,634 crore. Out of this 1,634 crore, 421 crore is the awards won.
Okay, sir.
So there is no change from December here. And this 421 crore awards won are central government is 110 crore, state government is 104 crore, and private sector is 208 crore.
Okay,
and
sir.
Then balance is about 1,200 crore worth of arbitration claims pending in arbitration, which is 477 crore central government and 326 crore is state government and about 409 crore is private parties. So that is total 1633 crore.
Okay, and of this 1633 crore, how much would we have recorded in books?
Yeah, recorded in books is 582 crore. So that is like this 225 crore is against central government accounts, 123 crore is against state government account, and 234 crore against private party account. So total 582 crore are recorded in the books.
Okay, and sir, of these favorable awards of 421 crores, by when can we expect to receive some amount here?
I think this state and central government 212 crore, which are mostly NHPC and NHI, that we should receive this year. And private party 208 crore, that we may not receive this year because that is under court. So that will go in the court cases also. That will take 2 to 3 years time.
Okay. And against this central government and private, will we receive it against BG?
Yeah. Central government and state government against BG.
Okay. So far, how much would we have received in FY18, sir?
FY18 actually we received only 23 crores.
23 crores. And
actually it has tested the system.
Sorry?
It has tested the system works.
Right, sir.
Yeah. It took a lot of time, but it has worked. Yeah.
Okay. So this private and state, we are confident that it will come in FY19?
No, central and state.
Sorry,
private,
central and state.
Yeah, private will be in the court procedure, so it will be 2 to 3 years time.
Right, sir. And of the total recovery target of 800 crore which we mentioned, against that, when we started in FY18, our target was around 500 crores.
Mm-hmm.
So, have we been able to achieve that?
430 we recovered out of the old debtors. 430 we recovered. But our debtors level went up because of this GST impact. One thing is GST directly impacted about 190 crore of input credit. And because of the migration from old service tax mechanism to GST mechanism, it has affected the payment delays by the parties, because till the time the government parties are satisfied about the migration, they hold up the payment. So that also impacted another 400 crores. So total 600 crore worth of outstanding is because of the GST.
This will be a part of unbilled, is it?
That will be part of both billed and unbilled, both.
Both billed and unbilled.
Yeah.
Okay. And sir, if you can give me the breakup of retention and unbilled for this year FY18.
Yeah, retention is 561 crore. Okay. And unbilled is 3,972 crore. Yeah.
Okay, and debtors would be 1,451 crores.
Yeah.
Okay. All right, that's it from my side. Thank you, sir.
Thank you. A reminder to the participants, to ask a question, please press star, then 1. The next question is from the line of Kaushik Poddar from KB Capital. Please go ahead.
See, this time the auditors have made the qualification for this 800 odd crores. So are you systematically gathered in in a way so that such kind of qualifications will not be there next year?
I think so, because we believe that auditors also will gear up, and we will take them to project sites and also see them the reports, and it will take about 3 quarters. I think in 2 to 3 quarters it will be toned down considerably.
And when you announce the quarterly result, will you announce how much of this unresolved 800 crores is getting resolved every quarter?
No, every quarter the amount will be mentioned by the auditor. So 860 crore will be now 600 crore, then it will be known that 260 crore is resolved.
Okay. So the progressive reduction in this qualification will be notified in this quarter,
right? Absolutely right.
Okay. And this 8,100 crores as against 5,700 crores of this year, will you require increased manpower?
You see, basically not much, because manpower requirement will be incrementally lower, because project numbers are not increasing. Project size is increasing.
Okay.
So some of the new projects, when they are taken up, I think 100 to 200 on overall manpower of 7,000 people, 100 to 200 increment is not much, because in the past we have had 8,000 manpower, so that we have pruned down to 7,000 already.
Okay, and for 11,000 crore next in FY20, will the manpower be similar to the 7,000, 7,200, or for that you require
within 8,000? You see, in the past we have had 8,000 in anticipation of growth. That is pruned down to 7,000, and it will be well within 8,000 people.
Okay. So your labor, the staff and wage cost as a % of your turnover will be coming down?
Will come down, yes.
Okay. Thank you.
The construction labor, that is a separate thing, because that's the kind of...
Okay, labor is outside, they are contracted, so that should not be a problem. Yeah, that should be okay.
That's why the margin should improve.
Okay. Thank you. So for FY20, are you looking at, let's say, 14.5% as against 13.5%?
No, actually in our projections we have considered only 13.5%, because we have considered reduction in fixed costs like interest and depreciation only. But other costs, before EBITDA, we have not taken out of caution any reduction. 13.5% is the EBITDA margin we have.
Hopefully it should be better.
It should be better.
Okay then. Thank you.
Thank you. The next question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Yeah, sir, FY18 Capex and gross block numbers.
FY18 Capex is 107 crores, and gross block is 3,023 crores.
3,022 crores.
Yeah.
Okay. And the mobilization advance is how much?
Is just a second. Mob advance is 1,067 crores.
1,067 crores. Okay. And have we won any orders, or are we L1 in April and May?
You see, April and May we have taken a back seat, because we know that the order book is good, and the future bid pipeline, which I am saying 22,000 crore is already bid, and about 35 to 40,000 crore are where we are fully pre-qualified. The bids are under preparation. So we believe that the better margins and better bids orders are going to come. So we believe that this year we still have 9 to 10,000 crore order intake, although going slow during April, May and June, because we are waiting for good bids. Like we are not bidding for roads, we are not bidding for any other Mumbai metro parcel, but there will be other metro parcels that may be better, and we are not bid for this Bombay, Nagpur. But now we believe that there are a lot of inquiry. For each bid, there are only 4 or 5 bidders. So I think there are better times coming. So we are biding for the time. Amitabh, anything to say?
Sir, can I ask one more question?
Yeah, sure.
Yeah. Sir, just to understand more in detail, particularly for top line, as you already said that first 2 months it is 10 or 15% growth. So maybe now the June is already there and the second quarter being a monsoon would be lackluster. So if I'm just rough calculating, maybe the second half we are looking at close
second
to
quarter
65.
Can be good growth because the kind of projects that we have, because we don't have road projects, much of the road projects. There are road projects that will be only impacted, but other projects will not be impacted.
Okay. And for doing just a 2-3% kind of a growth, we did 107 crore capex in FY18, and for 40% growth also we expect only 200.
That is not a mathematical calculation, you see, because our depreciation charge is 200 crores. So to keep our equipment fleet young and efficient, we have to improve maintenance capex. And depending upon these My1 settling, etc., we have a large building portfolio of construction, so that requires My1 settling, etc. So that is how that what is necessary capex is done. But since the project size, ticket size is rising, the same equipment will produce more.
Mm-hmm. So, and sir, lastly, once again, just trying to get your confidence that we are confident to achieve 8,100 crore top line with a 2,800 crore debt and the reduction in the working capital.
Sure, definitely.
Okay, thank you.
Yeah.
Thank you. The next question is from the line of Prem Khurana from Anand Rathi. Please go ahead.
Yeah, good afternoon. Thanks for taking my question. Sir, just on this margins, I mean, when you say 13.5% kind of margin, these are basically the inherent margin that are available with the orders. But when you,
in the order book.
Yeah, so but when you report your numbers, I mean, is it fair to assume the margins would be lower than this number because you would be required to provide for these 106 crore rupees of Abhijit, and then there will be some more numbers that you would have to provide for. So essentially, in income statement, the numbers would look a little lower than this number, the inherent margin which are there with you in your order backlog?
You see, there will be other gains also. Like, you see, in every job we do provide for extra costs and provisions.
Mm-hmm.
So there are the profit and loss account is prepared on cost to complete method basis.
Okay.
So we anticipate how much cost will be incurred to complete it.
Sure.
So that is where extra padding is there. So therefore, you see, in other income there are various right back of excess provision, etc.
Mm-hmm. Now, how much that number tends to be? I mean, as a percentage of the top line, when you say, I mean, in terms of provisioning, it works out to 0.4%.
Yeah.
How much that number works out to be in terms of the write-backs that you do on a regular basis?
That is also about half a percent or so.
So somewhat similar to what you provide for on a yearly basis. But then Abhijit would be over and above this 0.4,
yeah,
right?
It will be extra, but other things will be these 0.4% kind of thing. And, but from year to year, quarter to quarter, it may vary.
Okay.
Over the last 10 years, average has been 0.4%.
Sure, sir. And so the new orders that you bid for, that you've been getting these days, how long does it take you to start working at the ground? As in, I mean, the day you get your order.
One good thing. This time, actually, now the time from bid to order is also shortened, and from order to execution also is shortened. Because mob advance comes quickly, and then we have to mobilize, and we have to start work. Because in some of the projects, even PMO and CMO offices are monitoring for an execution. So execution monitoring is very, very strong.
Sure. So 3 months would be the fair number?
Yeah, 3 months is fair.
Sure. So which is, I mean, basically what I want to understand was, I mean, we have opening order backlog around 18,000 odd crore rupees.
Yeah.
And we're saying we would be able to do almost 8,000 crore rupees, even if I were to assume that you would be able to get 9,000 crore rupees of inflows this year. I mean, essentially we're looking at almost 40-50% kind of execution from our existing order backlog. So given the fact that the average execution cycle tends to be anywhere between 2.5 to 3 years, would that number be possible?
No, our average is 2.5 years actually. And really speaking, if there were no delays, the execution cycle is 2 years only.
Okay. But given the fact that we operate in an environment wherein you're bound to see some or the other delays.
Some delays are bound.
So is it fair to have 8,000 crore rupees as a number, or, I mean, we are being ambitious again?
No, it's basically 18,000 crore. If it is 2 years execution, then it is 9,000 crore from the existing order book. But since there are delays, there will be new orders also coming in this year, which will require within 3 months some execution.
Okay.
So whatever orders we received in second quarter will be executed, will start execution from the third quarter, and third quarter from the fourth quarter. So,
okay.
You see, so far as business availability and execution capacity is concerned, there is no constraint. Only constraint was our working capital.
And sure.
That's why we self-restrained our growth in last 6-7 years.
Oh. And how about FY20? So what kind of inflows are we targeting for FY20? Do we have any number in mind?
Basically, now you see it's difficult to see the number, but then basically we would like to maintain 2.5 times the revenue, the kind of order book.
Okay. And just one last one,
Still in our projection, I can give you my number. The FY20 order book will be about 27,000 crore. So that means 11,000 crore, if it is 21,000 crore in FY19 and 11,000 crore, so there will be some 16 to 17,000 crore of inflow.
Oh, wow. Sure. And so just one last time, the order backlog number that you give us these days, is it adjusted for GST? Or GST is still a part of the order backlog?
No. GST is separate. It is in current assets. You see, our current assets and current liability both are bloated numbers.
Okay. Sure. Sure, sir. Thank you.
Thank you. The next question is from the line of Vaibhav Shah from ICICI Direct. Please go ahead.
Hello.
Hi.
Yeah, good evening, sir.
Yeah, good evening.
Sir, just wanted to check it out. How much is our outstanding gross debt in our books as of now?
3,600.
Okay. And sir, at the beginning of the year, we had a target of close to recovering 500 crore from the old debtors. So how much did we collect in this year?
We collected from the old debtors 430 crore.
Okay. So sir, I mean, if we were to look into the broad max, let's say even if collecting 430 crore our debt remained actually has increased in this year and going ahead when we would be...
Debtors increased, as I mentioned earlier, I think you may not have picked up, because of GST implication and because of ongoing negotiation with the clients on migration from service tax to GST took a longer time. So one thing is that GST input credit, because on purchases you have to pay the GST. So 190 crore of GST input credit is there in our current assets, and plus delay in payment which was resulted because of GST migration is about 400 crore. So total 600 crore debtors are, increase of debtors is attributable to GST.
Okay. And sir, looking at the guidance of 8,100 revenue, let's say there would be incremental revenue of 2,500 crore.
Yeah.
So even if I consider working capital cycle of, let's say, close to 150 days, that would be increment.
Incremental working capital cycle is 90 days.
Okay. So that would be...
Additional working capital will be required.
So 600 crore would be the additional requirement. And sir, how much would be the Capex requirement for this year?
200 crore.
Okay. So 800 crore would be the incremental requirement. At the same time, even if we recover dues to the extent of 800 crore from the existing clients or old debtors, then still we would remain at the same level of debt, and whereas we are guiding close to the...
QIP money and promoters money will also have come in, no?
Okay.
400 crore QIP and 50 crore from promoter, and promoter will put in another 75 crore during the year.
Okay. So, sir, roughly that should settle down close to the 3,200, or, should we see the further reduction?
Yeah, 2,800 crore, because that is as per the projected balance sheet.
Okay. And, sir, what would be the Capex requirement for the next year, FY20?
200 crore each year.
Okay. Okay. Thanks a lot, sir.
Thank you. The next question is from the line of Viral Shah from Emkay Global. Please go ahead.
Hello. Good evening, sir. Sir, just couple of questions. One, in the opening remarks, we had mentioned that there were some project delays, right? And because of it, the fourth quarter was affected. Has that been resolved in the April and May month? And which were those projects?
That has been resolved.
And which were those projects, sir?
Basically, that was the Srinagar project and one West Bengal project.
Okay. And what will that amount be in the, or what percentage of the order book would be that two projects put together?
No, these are 250 crore each project.
Okay.
Total 500 crore.
Okay. And of this...
But they had gathered the momentum and speed, so that was affected. Yeah.
Okay. And post that, there are no slow-moving orders in our 18,000 crores of order book, right?
No. Slow-moving means, you see, where the payment is not coming, then we delay the project. Otherwise, there are no slow-moving.
Okay. Are such projects where payments is a problem or working capital is a problem?
I think out of 19,000 crore order book, 2,000 crore will be this kind of projects.
Roughly around 10 to 15%.
Yeah, about 10%.
Fair enough, sir. So despite having an order book which is around 10%, we are still confident of achieving our 8,100 crore.
Because the new order inflow will be 9 to 10,000 crore. That also will contribute towards the current revenue.
Fair enough, sir. Fair enough. Thank you so much, sir, and all the best for future.
Thank you.
Thank you. Participants who would like to ask questions, please press star, then 1. The next question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Yeah, sir, you said out of the promoter, which promoter have put in 50 crore and another 75 crore would be put in this year and the remaining would be in the next FY20.
Right.
And this would be at the same price of 554 or it will be every time it is a different price?
I think you should be knowing the market because there's the warranty issued at 554. Now the warranty will be converted into shares.
Okay. Thank you, sir.
Thank you. Participants who would like to ask questions, please press star, then 1. As there are no further questions from the participants, I would now like to hand the conference over to Mr. Parvez Akhtar Qazi from Edelweiss Securities for closing comments.
Thank you everyone for attending this call. We would also like to thank the management of Simplex Infra for giving us this opportunity to host the call. Mr. Kakani, would you have any closing comments to make?
I think we have your questions were such that we have answered everything, but the main thing is focus on the growth and the profitable growth, and I think the good turnaround cycle is with us, and it will continue for next 5-6 years. So we are looking forward to next 5-6 years of very good growth and a profitable growth. Thank you.